Right. Thanks so much, Tim, for the introduction, for the invitation, and thanks everyone for being here. Last weekend, I ran a half marathon and I can barely move. So I'm very happy to stand in front of the camera and not move by means because I'm actually kind of questionable decisions folder. That's where it went. As Tim mentioned, I will be giving this talk on what is a working paper with Sebastian Dissner and David Hope. And this is in a way a prequel to the larger project that Tim mentioned. It's piece of collaborative work which we've been working on for quite some time now, and then out of these conversations in kind of trying to figure out this paper, we also then came up with this grant proposal, which was successful and which we're working on right now. But this is kind of comes earlier a little bit. It's a narrower project. And the title is Embedding Skill Bias, Technology Institutions and the Skill Bias in Wages and Benefits. Are there? With the mouse. Yeah. Oh, there's. Okay, so just to give a quick overview of how the presentation is going to be structured, I will say a few words on the background of where this paper comes from, the literature within which we hope to situate the paper and engage with. I will then introduce what is kind of our theoretical argument, which will be followed by two pieces of empirical analysis, one focusing on wage premia and one on non-wage benefits. And I will say in a moment why we think both things are important and what we do about those. And then I will have a few points of conclusion. Okay, the background for this paper is, broadly speaking, in this structural trend of transition from a Fordist to a post-Fordist knowledge-based economy, which, as we know, comes with very significant socioeconomic changes of various nature. So the increasing centrality, for example, of information communication technology for firm production strategy, the rise of mass higher education system, a major shift out of manufacturing and into services, large increase in female labor force participation, and all sorts of these kind of underlying big structural trends. And one of these has to do with income inequality, which many scholars have pointed at and kind of identified as a relevant feature of this kind of socioeconomic transformation. And this is this issue around income inequality is the kind of element here of the transition from a Fordist to a post-Fordist society that we want to engage with in this paper. And in particular, we kind of engage with this literature on what are the determinants of income inequality, and I guess a kind of a correlated question is whether it's inevitable or not. In terms of kind of framing this paper in the literature, we thought about essentially presenting two broad camps, how the labor economics literature has kind of gone about this, and then the comparative political economy, which is also the viewpoint that we would take here. So the labor economics essentially treats inequality in the transition to a knowledge-based economy as the outcome of the relationship between skills and technology. The reason is that technological change has an asymmetric effect on workers at different skill levels. And in particular, crucial to kind of understand dynamics of inequality is the complementarity between technology and highly skilled workers, which tend to be, roughly speaking, would be the university-educated workers. And the idea here is basically that that because higher level skills that you typically acquired by a university education are complementary to technology. So in the context of technological change, if you possess those skills, your productivity is enhanced and you can reap the benefits of these, whereas workers lower down the skills distribution would not benefit either because they actually may be replaced by technology or because they are in occupations characterized by the type of skills that are not really complementary to technology, and therefore their productivity would not be affected. And the prominent kind of explanation of how these dynamics, this interplay between skills and technology leads to inequality is this idea of a race between education and technology, namely levels of inequality would ultimately depend on who's ahead in this race between education and technology, and this race between education and technology theory has been developed with empirical reference to the case of the US, where until the 80s, you have a situation where essentially education outpaced technology. So education expanded faster than the pace at which technology was kind of permeating the labor market, and therefore inequality would go down. And then since the 80s, the reverse held true when essentially technology pulled away, educational expansion didn't catch up, and the outcome is one of rising inequality. And this would be, there are other, there's variation on this theme, but broadly speaking, kind of labor economics view on this relationship of, on these issues around inequality in the transition to the knowledge economy would kind of point in the direction of we need to look at the relationship between skills and technology to understand what goes on. Then, from a comparative political economy perspective, we know that things are perhaps more complicated, that it's just not a matter of kind of supply and demand of production factors, but inequality would be understood as being mediated by political economic variables, and there is a long tradition in comparative political economy of kind of showing how and which political economic institutions or variables matter in mediating this, in shaping patterns of inequality. If we zoom into this question of inequality specifically in the context of the transition to a knowledge-based post-industrial economy, which is what we focus on here, we argue that we can categorize current comparative political economy thinking along three lines, which we name first the pessimists, and this would be mostly in line with the work of Karen Nowell, of Wolfgang Streeck, who basically argue that liberalization makes it impossible to uphold social solidarity in this kind of post-industrial knowledge-based world, because those actors, say trade unions and those institutions that sustain the egalitarian outcomes in the kind of in the 2-3 decades post World War II, have collapsed, and kind of social solidarity would not be feasible, being these actors and institutions absent. Then you have, at the other hand, a more optimistic view, which is the one that has been put forward, for example, recently by Iverson and Soskis, where they actually argue that democracy and capitalism stand in a symbiotic relationship, and that there are joint interests between governments, the electorate, and businesses, and these joint interests materialize around policies such as investments in higher education or R&D, which essentially would be demanded by large segments of the electorate, because it would allow them to reap the benefits of this transition to a knowledge economy. Governments would be happy to provide them because they are demanded by large segments of the electorate, and businesses would be on board too, because that's what allows them to kind of thrive in these high-end segments of the kind of global value chain, so to speak. So this is essentially an optimistic view, which argues that because there are this mutual interest between the electorate, between governments, and businesses, you would have progressively the pool of winners in the knowledge economy that would expand, because there are incentives to promote the policies that would make this happen. And then you have a third view, which kind of say it depends. And it is possible to uphold egalitarian outcomes, but it depends on specific policy choices, which often are referred to as social investments, so investment in education, family policy, and so on and so forth. And up until here, it's not too far away from the kind of Iverson and Soski's view, but then they kind of qualify that this kind of argument by saying, but unlike Iverson and Soski's, where they basically say there is this kind of joint interest of all the major parties here and stakeholders in promoting these policies, they actually argue that these policies tend to be promoted or underpinned by rather idiosyncratic institutional political configuration that are not as easy to that cannot be found as easily, and they tend to be usually the kind of Scandinavian countries, right? So essentially, this is a third position which shares this kind of optimist view that we have in Iverson and Soski's about the role of education and skills policy, for example, but they also kind of qualify this by saying it's not so straightforward to see these policies actually being promoted. So this was a bit where we think our contribution and paper is situated, and now I'm going to say a few words on how our theoretical approach kind of builds on this stream of comparative political economy work that I just summarized, but it is also different in some important ways. So essentially, we do agree, in particular with the last group of scholars, that they kind of put forward this basic idea that there is something that mediates the relationship between skills and technology. And broadly speaking, this is kind of a typical CPE type of argument, right? There is something more than just this kind of functional relationship between skills and technology. But we are not convinced that what has been identified as the something that does the trick here has been fully identified or fully theorized yet. And there are a few issues here with the kind of current CPE literature that looks at this issue of inequality in the transition to a knowledge economy. So the first one is that technology is kind of out there in a lot of this work, but in a lot of this work isn't really explored empirically. So it's kind of given as the relevant context, as the relevant socioeconomic context, but you rarely find a proper empirical exploration of how much technology is out there, or how did technological change develop, to what extent is this different across countries. And then more specifically, with some of the approaches that I have summarized in the previous slide. So one issue that we have with the liberalization argument is that the way we read it, actors and institutions are conflated to an extent. And this is kind of makes sense in a way, because a lot of the liberalization story comes from the case of Germany, where if you look at, let's say, union density and collective bargaining coverage, they both went down almost at the same pace over time. But actually, if you look across the board, across a larger sample of countries, what we see is that indeed there is this kind of declining trend, more or less there, in terms of the role of these actors, essentially to the center left of the political spectrum. Unions would be the typical example, but actually, when it comes to institutions, it's a much more mixed picture. There is this very nice article from a few years ago by Jan in Socioeconomic Review, which kind of maps how corporatist institutions have developed over time. And there shows quite nicely that you have a very mixed picture. You have countries which, over the last 30, 40 years, they started at high level of corporatism and kind of maintained that. You have countries that started at high level of corporatism and this decreased. You have countries that were at lower levels a few decades ago, and they're still at lower levels, and there are even a few countries where some of these indicators went up. And this essentially to us suggests that we might need to think about decoupling actors and institutions, in the sense that, as in fact we would expect of institutions, they may be stickier than the actors that kind of support them or even have established them. And we'll come back to this at the end again. And then the second kind of question mark that we have here is whether education and social investment oriented policies can really do the trick here in terms of curbing inequality, right? So, for example, Iverson and Socius put a lot of emphasis on the expansion of higher education, but we also know that the expansion of higher education may or may not lead to the expansion of good, well-paid employment, because in some labor markets may just not be able to absorb these graduates, and you might end up with skills mismatches, for instance. Or more generally, if we agree with the labor economics view that technology is complementary not just to any skill, but to a rather specific subset of skills, namely this kind of high cognitive skills, then this kind of investing across the board in skills, is it really going to do the trick? If we buy the skill bias technological change argument, then probably not. So building on these kind of critical remarks that we have on kind of existing arguments and theories, we want to propose an approach that, first of all, takes seriously the relationship between skills and technology. So we want to at least attempt to measure how much technology is out there, how does it vary across countries. And that foregrounds the role of institutions and collective bargaining in particular, which we will use not necessarily as collective bargaining per se, but as a proxy of employer discretion, and I will get there in 2 slides. So now on to our kind of specifying a little bit more our theoretical proposition, which comes in 2 steps then. So, and again, we've been kind of critical towards some of these existing explanations, but we actually think that there are really good arguments in there, and we actually build on many of them. We just recombine them in a way that we think might kind of bring us to come up with a more nuanced theorization. And indeed, I say this because the first step of our theoretical thinking here comes precisely from one argument that Iverson and Soskis made in their 2019 book on reconceptualizing the skill-technology relationship in a way that is slightly more nuanced and slightly different compared to how, for example, labor economists think about it. And in particular, they do say, yes, technological change is expected to boost demand for university-educated workers because their skills are complementary to technology, and in particular to ICT, but they also argue that the returns that high-skilled workers generate for firms in the context of technological change also depend on both their individual skills and their interaction with other highly skilled workers. And that means that firms would be particularly benefiting from having a group of, we could think about as kind of core highly skilled workers that forge historical relationships between them and between themselves and firms, because the returns on technology can be maximized if highly skilled workers work together for a period of time. In a way, what the argument implies that if you really need engineers to work out something, it's not the same as having a group of engineers working on a certain technology or with a certain technology for extended periods of time, or just having a new engineer coming in every day. And this has implications because if we buy this argument about historical relations, then firms, they not only need to recruit these highly skilled workers, but they also need to find ways to retain them for some time. They don't want them to kind of come and go. And if that's true, then wages is part of the story, because you can, of course, attract highly skilled workers by offering high wages, but also benefits could be selectively deployed to kind of tie workers that firms consider strategically important to them to create this kind of historical relations. Okay, so the idea is that if we agree that this notion of historical relations is important, then we should expect that firms would want to use wages and non-wage benefits and deploy them selectively towards those group of workers that they deem to be strategically important in the context of technological change. But then the question is, to what extent will firms be able to pursue this strategy of kind of selectively rewarding and retaining a subset of workers? And here in this, in a second step, we draw again from some of the authors that we just criticized, namely Baccaro and Howell, who argue that a key development in contemporary industrial relations systems is a steady expansion of employer discretion, which grants them greater discretion vis-a-vis labor and state actors. Namely, they argue that because kind of collective institutions or the role of the state has been declining, then firms kind of have the upper hand in terms of setting the conditions for workers. But as I'm going to show in a moment, and as we argued before, actually this kind of these institutions that kind of constrained employer discretion have not declined everywhere, and certainly not to the same extent, not at the same pace. So essentially, we argue that greater discretion allows more scope for firms to pursue strategy of selectively rewarding certain group of workers through wages and benefits, but that the key element for firms to be able to do this would be in the presence of collective bargaining institutions, which vary still very significantly across countries. So essentially, we argue that where collective bargaining institutions are strong, employer discretion is low, relatively speaking. And therefore, the ability in this context of employers to selectively reward and retain a subset of workers will be more limited compared to a situation in which you have weak collective bargaining institutions and therefore higher discretion and therefore more scope to deploy wages and non-wage benefits selectively, only to target those workers that are considered strategically important in the context of technological change. So in short, just to sum up this, our kind of theoretical argument is the following: that technological change strengthens the labor market position of university graduates and pushes firms to create the conditions for building historical relations among highly skilled workers. And this can be achieved by selectively deploying higher wages and non-wage benefits towards this particular group of workers. But the labor market advantage of university educated, so this would create a labor market advantage for university educated workers, which is, however, mediated by the educational context, since the ability or inability of employers to reward highly skilled workers selectively goes hand in hand with liberalization or lack thereof in collective bargaining institutions. So this is what we want, what we'll try to demonstrate in the second part of this paper. So to do this, then, if the argument is that there is an element of rewarding through both wages and non-wage benefits, we want to do two empirical analyses, one focusing on wage premia and one on non-wage benefits. So the first bit of empirical analysis, a wage premium analysis, and this builds on a national level panel data set that covers 15 OECD countries from 1995 to 2017. Our dependent variable is the 90/50 gross earnings ratio. Now, this deserves a moment to say why we take this as dependent variable. Because essentially what we're interested in is in the wage premium of university educated workers. existing works, existing research, in particular in economics, kind of takes the 90-50 gross earnings ratio as a proxy for university educated wage premium, although it is not exactly the same thing. Now, there could be a measure of higher education wage premium that is a direct measure of it. This is, for example, has been used by Bystander and Darmin-Jean using the Luxembourg income studies. But if we match that with our measure of technological change, the number of observations would drop from over 200 to around 75, which makes it difficult for us to kind of perform the analysis. But we plot it. We plot our 90-50 gross earning ratio against a more direct measure of the education premium of oops, this is a touch screen.
Yes.
Sorry. Against the exact measure of the education premium, and we can see that they correlate to very highly, and it's a correlation of near 0.9. So essentially, we're happy with the 90-50 gross earning ratio as our dependent variable, but we also run as a robustness test also with the other variable, and we lose significance, but everything goes in the expected direction. So the main independent variables then, we have a measure of digitalization of technology, which we use digitalization as a proxy for technology, and in particular we calculate the ICT capital stock per employee, and we're using here the EU PLEMS data, and this is become kind of quite a standard measure of ICT. And then we have bargaining coverage rate, which is our proxy essentially for how much discretion employers have to reward a particular group of workers. And theoretically, we're interested in particular in the interaction between digitalization and bargaining coverage rate. We have a number of control variables. Some of them, we try to match them theoretically to kind of the alternative explanation. So, for example, the share of the population with a tertiary education, both to control for this kind of race between education and technology, but also more generally to account for the idea of expansion of higher education as an alternative explanation driving these patterns. R&D investment, which again features prominently in Iverson and Soskis, active labor market policy spending as a bad proxy for social investment, and union density to kind of capture this difference between actors being unions and institutions being collective bargaining. And then we have other standard controls such as unemployment rate, trade openness, and so on and so forth. So before we look at some results, just a couple of descriptive ones. So the first, these charts here show you the pace of digitalization across countries, and we see it's kind of stronger in some countries than others, but you don't really see any country where there is a downward trend here. So we argue digitalization is ubiquitous across the advanced economies, but there is substantial variation in bargaining coverage. And as I mentioned before, we see different patterns in terms of persistently high levels, persistently low levels, decreasing levels, and in a few cases like France, for example, even marginal increases. Methods, we run a two-way fixed effect model with robust standard errors. We also check, as I mentioned before, the robustness of our results to several alternative specifications, and in particular using also the alternative dependent variable of the direct, which is the direct measure of education premium from the Bystander and Darmin-Jean paper. We also perform a placebo test where we swapped the 90-50 earnings ratio with 50-10, because of course, if our argument is that this has to do with the kind of top end of the labor market, then we shouldn't be seeing the same results coming through if we take the 50-10 earnings ratio, and it comes out indeed as a non-significant when we change the dependent variable from 90-50 to 50-10. And we then run a separate analysis where we have digitalization as our dependent variable and collective bargaining as independent variable, and I will say in 2 slides why we do this. But just briefly on the results for the wage premium analysis. Here we are in particular interested in, so we see that digitalization is a positive and statistically significant effect on the 90-50 gross earnings ratio. And here we are particularly interested in the interaction term between digitalization and bargaining coverage, which is as expected negative and statistically significant. This means then that the effect of digitalization on wage premium is greater when employers have more discretion to set wages and differentiate among workers based on skills, that is when the bargaining coverage rate is lower. So that's how we interpret these results. And here we show this as average marginal effects of digitalization on the 90-50 earnings ratio. And what we see is that digitalization is associated with increases in the wage premium, but that this effect decreases as bargaining coverage increases. And in particular, when bargaining coverage rates exceed around about 80%, the effect of digitalization on the wage premium becomes statistically insignificant. So this is, in a way, the main result for our first bit of empirical analysis. This which we interpret as kind of supporting our idea that the wage premium for university-educated workers in the context of technological change is higher in those contexts where employers have more discretion to set wages. Now, clearly, this is correlational. We can't really disentangle whether the mechanism at work is the one that we imply. But what we can do is we can rule out what we think is the main alternative mechanism that could drive these results, namely that collective bargaining keeps wage premium, keeps the inequality in wage premium lower in the context of digitalization by holding back countries to digitalize to begin with. And so to check whether that's the case, we then use digitalization as dependent variable, and we want to see whether collective bargaining actually holds back, in a way, the knowledge economy to begin with, right? Which could be then reflected in a less unequal distribution of wages. And actually, what we find is that collective bargaining, if anything, has a positive and statistically significant effect on digitalization. Then again, this is not surprising. There's been recent work by, for example, Timo Seidel or Ton van Overberge in Maastricht, where they both show with different measures of digitalization and technological change that actually collective bargaining institutions facilitate this kind of upgrading. So in a way, we can't really demonstrate that the mechanism at work is the one we imply, but we can, I think, demonstrate that the main rival hypothesis doesn't hold true, and actually digitalization is, and actually collective bargaining pushes up digitalization. Okay, now we'll move on to the other bit of the empirical analysis, which has to do with non-wage benefits, which again, just to recap, is what we expect to matter in terms of employers trying to tie specific groups of workers that they consider strategically important to their firms, and they might use non-wage benefits to this end. Here we run a multi-level analysis using. We need to change kind of approach because it's we're not aware of any good national level data that would tell us about the extent to which these non-wage benefits exist. So we run a multi-level analysis using data from across 11 OECD countries, across 3 waves of the European Working Conditions Survey. So this is individual level data, which has the following question. With regard to your earnings from your main job, do they include advantages of any other nature, for instance, medical services, access to shops, etc.? This is far from perfect, but it's been, we think is the most suitable question in the survey to kind of ascertain whether employees are receiving non-wage benefits, and it's also being utilized for in a recent paper by Riva and Rizza as a proxy for access to non-wage benefits. We think that is a decent proxy, not perfect, but decent, because it should pick up access to employer-provided benefits such as health insurance and perhaps a broader range of non-pecuniary benefits such as access to shops, company cars, subsidized food, etc. Then we have, as main independent variables, we have digitalization at industry level, which we can match to the respondents in the survey. We have individual level individual level information about the respondents, about whether the respondent has a higher education degree, and then we have national level collective bargaining coverage rate, and we control for a number of individual characteristics that are available from the survey that we think might influence whether a company decides to offer kind of a non-wage benefit to a worker, namely gender, age, contract type, and the size of firms. We run a linear probability model with country and year fixed effects and robust standard errors, and we also check the results for alternative specifications by rerunning the analysis using logistic regression models. To avoid the 3-way interaction, then we perform a simple split sample analysis of countries between high and low leverage, low levels of bargaining coverage, which we'll get to in a moment. So here first is are the results for the entire sample, and it shows that digitalization boosts the probability of receiving non-wage benefits for workers both with and without tertiary education, but that the effect is substantially larger for workers with a university education. So in other words, employers appear to disproportionately reward highly skilled workers with non-wage benefits in digitalizing industry. Yeah? So this is the average effect, the average marginal effect of digitalization, the probability of receiving non-wage benefits by educational background of the respondents, okay? And then we run the same analysis, but splitting the sample between countries, those countries that in our sample have above and below average bargaining coverage rate, and we see that the slope is much steeper in countries with below average bargaining coverage rate. So it's there is a greater difference between the probability of receiving non-wage benefits being a highly skilled workers in countries with low bargaining coverage, which again we think it's a proxy for greater employer discretion. Whereas on the left side or your right side, you see the countries with above bargaining coverage rate, that is where employers have lower discretion. The difference between low and high educated workers in the probability of receiving non-wage benefits is much smaller. And then I come to my conclusions, given that Tim flagged the 5 minutes mark. So a few points here. Again, at the more general level, through this paper, we hope to develop the CP literature on the distributional implications of the transition to the knowledge economy. And our core theoretical contribution that we would like to make is that we want to argue that by limiting the discretion that employers have to selectively reward highly skilled workers, institutions are more important than social investment policies in explaining distributional outcomes. And I think an implication of this is also that institutions seem to be more resilient than the actors that used to support them. We also argue that hopefully that collective bargaining institutions seem to resolve an important equity efficiency trade-off in the transition to the knowledge economy. That is, they contribute both to push up digitalization while keeping inequality at bay in the context of increasing digitalization. But clearly, a question that emerges here is that we show here, and we make the argument that institutions are more resilient than the actors that support them. But clearly, we know, again, from the comparative political economy literature, that institutions are unlikely to live forever without meaningful coalitional work, coalitional support. So maybe this is the picture that we draw here may not be lasting forever. But the previous point about this kind of collective bargaining seemingly solving this efficiency equity trade-off might perhaps be a good way of kind of revitalizing political support for collective bargaining institutions, because they can be framed as combining equity and efficiency aims. Then finally, a point that I presented this paper a few weeks ago at a workshop in Switzerland, and it's finally a point that Patrick and Menegger kind of pushed us to think about, and but I won't implicate him in how I'm presenting it here. But essentially, the comment that I think he made, and that I thought it was very clever, and I'll try to kind of put it out there for you in case it's an interesting point of discussion, is whether one of the major theories that we use to kind of understand contemporary changes in advanced democracies, namely the dualization theory, whether in this story tells us that that there is a dualization story, but it's kind of turned to its head compared to the way we've been thinking about it. Namely, in the kind of standard dualization story, we would assume that institutions support or favor core workers, and it is the lack of institutions that kind of let marginal workers down. Whereas in the context of the knowledge economy, because what we might think of core workers as these highly skilled workers that are complementary to technology, and they can reap the benefits of technology by virtue of their market power, then it's almost the other way around, that institutions actually kick in to support those workers that are actually marginal workers, and through collective bargaining, they do not lose as much ground from the new core workers that are highly skilled workers. So in a way, it's still kind of a story that we can somehow think in terms of dualization, but the relationship between, but the effect of institutions on different groups of workers in the labor market seems to actually go the other way around. But this is more of a discussion point, and I thought it was an interesting remark that I thought I would acknowledge, but make mine as well. So thank you so much for your attention.